A warm good evening to all the participants who have taken this evening to join this webinar. The recent events like war, interest rates, inflation, along with supply side constraints has made the market highly volatile, and mitigating the risk is the paramount objective of any fund manager now. Today we have CEO and fund manager of Right Horizon, Mr. Anil Rego, and he is an entrepreneur and a writer. He is a diverse personality. Right Horizon has completed 18 years of successful journey in this field, and as a group they handle about 1,800 crores of AUM, out of which 600 crores is in the portfolio management services. Anil is well known and respected figure who writes articles in leading print publications and a regular invitee for his experts' comments, for his deep understanding of the market in different business televisions. By education, Mr. Anil is a CFA from Institute of Chartered Financial Analyst of India and holds a post-graduation in finance. We will have a presentation from Mr. Anil for about 40 minutes, followed by a Q&A. This over to you, Mr. Anil.
Yeah, thank you, Mr. Sivaraman. Thank you for the introduction. I'll just share my screen. Welcome to this webinar, and thanks for the participation. Yes, markets have been volatile in the last few months. After a good period, after a good run that we had post-COVID, so we had nothing much to complain at that point of time. Okay, but right now we've seen some good volatility. In fact, volatility on the global markets has been even worse than in India, and all of us are thinking about how do we now balance risk and return, right? In good periods, I remember when things were going good, we had a lot of people coming in saying that, yeah, can I invest in this mid-cap, small-cap fund? We had a number of clients also reach out to us saying, I would like to invest in crypto. Okay, and that's a normal cycle that one comes in. And of course, on crypto, I just told them that I don't have expertise in this, and I'm not comfortable with investing in an asset class which is not yet completely regulated, and the regulatory framework is not complete in India at least. So that is something that one doesn't like to work with unknowns, and of course the other part of it is that in some form it works counter to governments. If crypto becomes very successful, right, you would find that it will probably replace currencies. But the whole issue is that the governments are the regulators, and they create all the regulations. So at some point of time, you may just find something which is really crazy, and one comes in to cut it out in its bud. So yeah, but now, yes, we are suddenly in the time when markets are down, and a number of people are now coming back to me and saying, yeah, but how long will this last? Right? So that's something that that's how it is. Markets tempt you to do the opposite many times. Markets, take you in the emotion, and I hope that is something that you would learn from this and take home and implement in your portfolios, and do well from here. But before I start, I thought I just will run a poll and just check out what do you give higher preference to, right, while investing. Is it risk or is it return?
Participants, yeah. Please participate in the poll, please.
Yeah, I see some good participation happening. Yeah, please do complete your vote. We have almost like 60% of the people who already voted. Yes. Yes, we will give maybe 10-15 seconds. Okay. Okay, I think we can end the poll. Most of them have given their verdict. Okay, and yes, we can share results as well. We have, it's a very even battle today. Okay, with almost like 54% of the people saying return over risk. Okay, it means that we've not sufficiently seen the bear market. Okay, right? Because I think when that happens, you'll probably jump the other side and say, yeah. Now I think let's give preference of risk over return. Personally, as wealth manager, as an asset manager, as an investor, okay, and as a professional, I normally give preference to risk over return, okay, because my experience over a number of market cycles is that the more, if you manage risk, right, and you're in the right asset classes, return will automatically follow, right? So that's my 2 bits, but I think it's been a pretty even one. But I also keep in mind that when investors come to me, right, 8 out of, or probably 9 out of 10 people come to me and say, what is the return you can deliver, right? Very few come back and say, how do you manage risk? Okay, and I think that is something that I would like each of you to start looking at more actively today, right? Because I think that will really make a whole lot of difference, that you keep the return, okay, that you have achieved. Yeah, so we'll just capture a little bit on how our the last market falls, and how it has been in terms of the Nifty versus Nasdaq versus S&P 500. It's all there. Nifty fell to 15%, while you had S&P 500 actually fall 21%. It's one of the few times that the S&P 500 fell more than the Nifty. And interestingly, Nasdaq, which everybody was so bullish about, suddenly fell 31%. So it's been a very substantial fall. Of course, in India as well, the small caps fell like 34%, which is a steep fall, which is why for many of us, may actually start seeing and believing that, yes, this is something which is real right now, because in your portfolios, if you have mid and small cap stocks, they would have fallen sharply. Now, why did this sort of happen, and what is the fall due to? I think a lot of it is a trigger point possibly was the Russia and Ukraine war, and that resulted in certain disruptions to commodity prices, because Ukraine is a very important participant, and also there were sanctions against Russia, etc. So that further added to some of the issues. And on the left hand side, you can see that it really spiked up inflation, and it's one of the very few periods where I've seen, say, the USA inflation higher than that of India. It's also possibly why markets in the US, etc., got spooked much more than in India, right? Because the inflation was much higher than what they are used to, at least in India. We have seen 7% in the past. It's nothing unusual for us. Okay, but imagine, in a period where people are very used to low interest rates, and low interest rates sort of one of the key factors to, a very buoyant US market for the last decade. Okay, and you find inflation sort of spiking up significantly, definitely a big cause for concern, and that resulted in central banks having to come back, and this is my point sometimes, that markets may not give a chance to central banks, because they have to decide between the devil and the deep blue sea, right? You either you manage inflation or it is growth, right? You impact growth. So now at critical points when inflation goes above a certain level, and the way it has gone up, I think all central banks and governments will give precedence to inflation over growth in the economy. So that is something that, and what this means is probably there are more to come. Okay, and that's the bad news in some form. But I think markets also go and discount some of these, changes in, of the future and discount it upfront. So that is the good part of it, that markets tend to discount the future. Now, if we come back and look at it, what is, how Indian markets also got a little impacted is because of the FII flows and the DII flows being counter. Normally, you find them, they are counter, but FII flows between October 21 to July 22, we took a period of outflows. It is almost like close to 4 lakh crores, right? Has gone out of India, and that's a huge amount. Okay, what saved markets for us here is, domestic flows almost like 3 lakh crores. So you can see that in the past also, whenever there were outflows, what happened? In probably 2008, 2009, the impact was very significant. But it also shows that our markets have matured. The scale has sort of improved from the past. Okay, but yes, also the Indian investor has been investing. Of course, there are some benefits that we got from and some props from the government, like the PF, etc. There's significant money that comes in from the PF into markets today, and that also has helped in this domestic inflows. Now, coming back to a little bit of how do we manage volatility, how do you take care of it? I think one critical thing that I would like to bring across is that of market cycles, and for us to be able to look at these in advance and understand where we are and how do we counter it. I think it requires a little more fundamental step back. So that's what I'm doing, in this part of my presentation on market cycles. Okay, so now this is how the market cycle actually is. Typically, it's divided into 4 parts. Okay, you can start from maturing, declining, bottoming, and rising, if I go in that order. Okay, so you will find that when it's maturing, the economy is sort of slowing down. Okay, you will find, inflation is higher, elevated, profits start coming down, and part of that is because of inflation. Part of that is because of sort of higher interest rates that have come in. Okay, and then you start seeing the declining phase where you probably also end up seeing a recession. Then the economy shrinks, credit bottoms out, profits contract. We all know all of this. Okay, and then after that starts a phase of bottoming out, and the declining phase will typically find some bit of stimulus coming in from governments, and that sort of expands in the next phase of bottoming out, and sort of the stimulus sometimes becomes a trigger point because markets are searching for a reason. Okay, and a large reason, the government stepping in and saying that yes, we want to turn this around at all costs. Okay, and the seeing it in action is where sometimes you find the bottoming out happen, which is also starts a phase of early recovery. Then interest rates also start bottoming out, and then you see the rising phase. Okay, where everything is good, right? From GDP growth, inflation slowly starts going up. Okay, and interest rates begin to rise. You also find credit offtake is higher. Now, so this is what we normally see. Now, a lot of people come back and say, where are we here? Okay, so I would think that this time it's an interesting one. We are diverging a little bit from, I believe, the global economy. So if I look at the US, for example, I think we're probably in a declining phase. We've already seen a 30% fall. You're starting to see many of these factors, much more aggressively happening, right? For India, we had last decade, which was very poor for us. So I would think that we're, one would also say that maybe we are in actually that early bottoming out, okay, or that type of phase, which we can see between declining and sort of bottoming out. So that's some good news for us. We're also seeing certain parameters like, interest rates had already, sort of bottomed out sometime back. So which is why I'm saying, we are probably in this phase right now, and hopefully India should see a shorter and a less painful, decline than global markets. But you must keep in mind that, you cannot look at India in exclusion, right? So you have to look at it as part of the whole global economy. And if the global economy, and especially the US and markets where, flows happen very strongly in and out, and they trigger flows of FIIs, it's definitely going to impact us. So that's something that we keep in mind. But yes, I've also covered some bit of stuff around, valuations and how we are. So it's not typical for, a peak green type of economy. And that's something that we will discuss as we sort of move forward. Now, what is the primary concern of ours? The primary concern is this, this is the current chart of the Nasdaq. Okay, you'll find that sort of it is come right down to the 200-week moving average. Okay, so and the previous time it actually came down, it touched it and moved from here was in the COVID period. So the question now is, can it just bounce back from here? Or the bigger concern is, what I would go back to an earlier period where Nasdaq did extremely well, right? And this is the period of, which ended in 2000. 2001 is where you saw a large fall. Okay, you would find that the Nasdaq really moved sharply. Okay, from if you see from almost like 800, it moved to some, above almost like 4,800 probably, right? So that is the large move that we saw. Okay, so almost 6 times, right, in a period between 97 and 2000. It's not a very long period. So we saw the good thing this time is maybe it's not such a large and steep rise. So hopefully we should not see such a large one. But the question is, are we here? So if you see this point where, it broke the 200-week moving average, right? And interestingly, it bounced from there. It went up higher. Okay, so that's how markets trap people, right? So it went up higher and saw a much larger fall. So I think this time we need to watch out for this. And in fact, our view is possibly that this is what is going to happen. We're going to see deeper cuts in. So, we have to be a little cautious there. The good part is, there is some divergence this time from India as well as, the Nasdaq and the global markets. But like I said, we cannot be insulated. So if something like this happens, then yes, technology stocks and some of those constituents will also get impacted. Not only that, you may find that outflows, because in periods of great volatility, global investors tend to pull money out of emerging markets back into developed markets. And that may just see, an impact to India because it has a certain percentage in this allocation, right, as part of the global allocation. So this is something that one would like to sort of keep this in mind. And one believes that in cycles, repeat, and this is very similar. So there's something that, we should keep in mind and just watch out for this risk. At the same time, the point that I'm trying to make is that in the long term, okay, a lot of these corrections look like blips. They look at very, very small in the overall. Actually, if I zoomed out further, the 2007, 2008 fall that happened, right, would look very, very small. Okay, that is because as markets go up, you'll just find that all of these look very, very small. So the good news for all of us investors is that if we don't do something silly and we suddenly don't get frightened and we, run out of markets at a low, okay, then, you just need to sleep over it and, possibly you'll see markets come back for you. So that's something that I want to give you that confidence. So when you start, if and when you see, large market falls and you feel very nervous, just hold yourself back. The other big picture that I would like to bring about is, this whole $5 trillion economy that I think the government also said India will sort of come into. I believe it's not a question of will it happen, right? It's a question of when it will happen. And sometimes, we tend to be a lot negative about ourselves, or we tend to look at ourselves much more critically, right, as Indians. And we have not realized that actually from being out of the top 10 economies in the world, we are now at number 5, right? So of course, the 5 is always a fighting thing between the UK and India right now, okay, because sometimes we have gone above, sometimes below and stuff. But I think there's no question about it. We will get there because our pace of growth is much faster. We are a developing economy, and we will go back to number 3. And some of the data even shows us coming back to number 2, going ahead of the US. which is sort of unimaginable. So that's something that we need to keep in mind. We are in a sort of a positive cycle of things. So the big picture again is that we should not miss out that in the long term you will see some large market growth for ourselves. Okay, this time of course, apart from the other parameters, we also have the growth driver of lower interest rates, and that again, if you go back and see how it propelled the US economy, okay, that's something that it's for us to benefit from. And I would say that volatility is also about managing risk. So if you manage risk, you'll probably see a lot less volatility, and many times the risk comes from not knowing what you are doing, right? And crypto is a classic example, right? So we are not sure, and sometimes even in equity market, some of us enter. Today a lot of clients come back to me and ask me for investing in a small cap portfolio, right? Why? Because it delivered a phenomenal return. Okay, and we'll see the alpha when we, it's a very staggering return. But the point is sometimes, okay, that's a return of somebody else. What you need to do is, if you are looking at and though I'm running the organization and stuff, and I still think that it's good to look at for the long term. What you need to keep in mind is that there are cycles, right? There are cycles between large cap, mid caps, and stuff like that. So we need to see, and look at risk also actively. And if you are touching a fund like that, you need to keep let's say a 5-year perspective. You'll probably still deliver the best return or the better return, right? But there is a risk associated with small caps, and that is something that one needs to sort of look at. Okay, and one of the key aspects of managing risk for us has been about a structured investing process. Okay, and that is something that we are very passionate about. And coming from I used to work in Wipro before, and coming from a technology background, right? A structured investment process is something that we strongly believe, and I will request while I can run through it. Okay, I'll request a couple of my team members who are panelists out here who are also co-fund managers. Okay, Vijay and Prabhas to sort of take us through this slide on the investing process at Right Horizons. Maybe Vijay, you want to start?
Yeah, thank you, Anil. Just a quick audio check. Is it audible?
Yes, audible.
Yeah. So basically, our investment process is divided into the 4 different steps. Okay. So it's starting from the screener, scorecard, then risk radar, and the pendulum. Okay. So I will take a quick overview on the each step that help the people or the viewers of this webinar to understand how we are doing the investment process at Right Horizon. So basically, we start with the screening process. So it's a very broad-based filter criteria like return on equity or return on capital employed, profit growth, promoter holding. So also the debt to equity ratio, kind of broad key matrices, which help us to bring down the NSE universe of around 1,300 odd companies. And also we also run the parallel filter on the BSE side as well to take care of the whole 6,000 companies universe listed on the BSE. And it helps us to come down to the 100 or 150 companies from the bunch of the basket of 6,000 odd companies listed across both the exchanges. And it helps us to focus on that 100 and 150 company which comes from that 6,000, that we can go and we can take it to the next step. So in the next step, which is the score card, so now we have around 100 to 150 companies which are passing through our broad-based criteria. So now what we do now as a fund manager, we understand that we can't do justice to each and every business if we go around out every 150 names that we have shortlisted in the previous step. So what we do, we try to come up with the more detailed matrices framework where we look at some of the forensic ratios. We also look at the valuation ratios, some of the parameters from the balance sheet side and the P&L side. It helps us to focus our time and energy in which order we should start analyzing those companies. Okay, so this 150 companies, we try to rank them on the different parameters. So it's a combination of quantitative plus the qualitative parameter. So now out of this 150 companies, we come up with the ranking. Let's take example. I'm just taking example of, let's say the HUL is coming the first in this score framework. So we will start with the first company. Let's say we need to focus our time and energy starting from the HUL, and then subsequently second, third, fourth, fifth best company. So it helps us to basically get the pecking order that how should we start analyzing the particular business. And in the next step, which is basically a risk radar framework. So there we try to look at the business level risk. So basically we go through the annual reports of the companies and earnings presentation, and also we try to interact with the management through the earnings call. Also we do ground level checks to help us to understand that how the consumer is thinking about the particular business. And also we come up with a detailed financial model which help us to understand and understand the opportunity size that the business is presenting in form of, let's say, the compounding of the wealth that we are investing on behalf of our clients. So that gives us the idea that the business has will be growing their earnings growth, let's say the 20 or 25% CAGR for the next 4-5 years. So we get the clear idea that this business has a certainty of generating in the earnings growth which is higher than the Nifty or the BSE 500, which is the relevant benchmark for the particular strategy. Also, like we have because we understand there are some unknown kind of parameter and a kind of risk that can emerge, which is kind of black swan category. So we also try to limit the exposure of particular stock to 10% on the portfolio side, and also on the sector level cap is around 30%, subject to the benchmark cap on the respective strategy side. So it helps us to protect from some kind of risk which is emerging from the unknown kind of risk side, like the COVID was a black swan event that no one could have predicted in their right mind. So it helps us to protect from such kind of events. And lastly, once we have taken the position and once we have carried out our deeper analysis of a particular business, then we try to set the price to earnings bands or different kind of valuation bands and some of the technical level targets for the stocks. Of course, we don't buy any business, or we don't take any position in a particular business for less than 3-4 years. Okay, so our idea is to get at least 2x return from the each business that we take from in our portfolio, with the earnings growth of somewhere around 20% odd range. So essentially we are targeting to double the earnings of each businesses by 4 to 5 years framework, 4 to 5 year mark. So that helps us to understand if the stock has moved ahead of its fundamental. So we try to take off some of the bait. So that is basically our position sizing framework, that let's say if some stock has moved up around 60-80% in first year itself after the after taking position. So we'll try to analyze that if there is any subsequent fuel left for the further growth, or is it the market had discounted the 4 years profit in the recent time. So we'll take to downsize the position by liquidating the position and allocating that capital to some other opportunistic name. So this is how the core process revolves around. So in this process, our main focus in the summary is to buy the quality businesses which have very strong fundamentals and a very clean management, also with the very strong certainty of the earnings. So we are not necessarily trying to pick the company which are growing at the fastest rate in the industry, but we want the company who can grow their revenues and their profits faster than the Nifty, but at a longer period of time. The duration of the profit growth should be more than, let's say, the 5 years, 6 years, with the least volatility in the earnings. So that is how our investment process revolves around the different strategies. Yeah. Back to you, Anil. Yeah.
Thank you, Vijay. So the way I look at it, right, I think the structured investment process helps us to be more consistent. And I think that's very, very important for us, because one of our core philosophy is to sort of work on delivering a superior risk-adjusted return. And as part of that, consistency really helps, achieve that objective. Okay, so, and the other is, about how cyclical things are, right? So you need to study market cycles, you need to look at sectoral movements, and which is why, this chart is very interesting. You'll find that, there are periods when you move from the right from the top to the bottom of the chart, right? So so that is something that one needs to be careful about, and you may find that, you know, interestingly, many times dark green is followed by a dark red and stuff like that, you know. So so you will find that, you know, whenever the large fall, then it comes up, and vice versa. So that's something that, you know, one needs to sort of keep that in mind. The other aspect about sort of managing volatility is, and the way we look at it is, you know, is about looking at a contrarian style that has worked very well for us. And basically, it's a simple philosophy of buying low, sell high. Okay, but the point is to be able to train your mind, right? So when markets are going up, you should start looking for, okay, when can the fall come and where's the risk start? Okay, and similarly, when markets are falling, okay, you know, when can the upturn come? So that's very, very important for a contrarian to start, you know, training one's mind to see how can you think differently from the market. At the same time, it's not so simple, right? It you know, it's very easy to say, you know, do the opposite, but many times markets can really keep going up and up. We saw the Nasdaq, right? It went up 6 times. After it went up 100%, you would have thought it's, you know, it's in you know, in that period up to 2001, right? So you may have felt that, yes, it's given great returns, let me be contrarian, 100%, let me sell. Similarly, when it's 2x, 3x, 4x, right? So the point is, it's not so simple in reality, because you have to look at multiple parameters. You have to look at the whole ecosystem. Sometimes you may just say, okay, let me wait for a turning point and then let me pull the plug. So there are different ways of sort of going about it, especially if, you know, based on a combination of data. Again, how do we manage volatility is also about, you know, looking at data, decisions based on data. So we look at, you know, the relative performance between, say, a mid cap and large cap, right? And something like this is basically a 3-year rolling return chart, a differential return. Okay, so that is something that you will find that in periods that mid caps have done 85% better than large caps, right? And so vice versa, you may find that it's maybe down, you know, worse by 35%. So if we are able to look at cycles and we find the certain bands at which you can sort of move to large cap or mid cap, that is something which can help us quite a bit. Okay, the other part about managing risk is actually doing a deep dive. Okay, can we search for those opportunities which, you know, fundamentally are strong, which have you know, a strategic fit, it is in line, it has tailwinds, and, you know, these are some of the examples of the research that we have done. In fact, we do a webinar, and all of these, I think, will be in public domain. Okay, and so some of these webinars we capture, say, APL, Apollo, Polycab, 𝐬𝐩𝐞𝐚, okay, at various points of time, and we look for, you know, what is it that can transition, you know, get them to be leaders, and we found that the best value comes from getting to an undiscovered name to a discovered name. So if you are able to catch a stock like that, you will really see, you know, very, very large and outsized returns. We would have a number of others, you know, examples that we have in our portfolios which may have seen even larger returns. Okay, but we just restricted ourselves to, you know, the webinars that we covered on, you know, some of these stocks, and we do this to capture process. Now, I must tell you that some of these may be in our portfolio, may not be in our portfolio right now. I'm not saying that this is neither a suggestion to buy any of the stocks here. Okay, but we're just trying to, you know, communicate a process, and this is just to illustrate that. Okay, and just to give an example of how we manage risk actively in the portfolio. Okay, one of the funds that we have is a FlexiCap fund. So interestingly, what we did in something like, you know, 2019, you know, somewhere in the probably the third quarter of the calendar year. Okay, so we ended up increasing weightage into pharma, right? And we also reduced financials. And why did we do this? Okay, one felt that the valuations of financials were looking very stretched. Okay, one also found that that time the P ratios also were much higher, and one got uncomfortable. One really felt that markets would sort of come down because of higher valuations. And in fact, what I did was I sent out a communication to clients saying that we expect Nifty to have another have a volatile year, okay, and not only that, one also mentioned to people that we are going conservative, okay, on our portfolios, and if markets do continue to rise, we may lose out on returns, but we wanted to manage risk, okay. And interestingly, while it's very difficult to guess, okay, COVID hit, right? It was definitely not an event which one could have predicted, but I think from a valuation perspective, I'm just showing how it helps manage risk. If anyway things are overvalued or looked very high on terms of valuation, then we took those steps and we were actually able to take advantage of the fall. So while markets went down, interestingly, on the fateful day of 23rd March, of 2000, we ended up actually deploying all the money, and part of it was because we saw the markets freezing twice. And for me, when there is fear on the street is where turning points come. Okay, so this is again what I'm trying to say: how to train your mind to start thinking differently, and and that to me was a clear point that when we have two frozen within the day itself markets, okay, and that too at a market level, not even at a stock level. Okay, that was the thing that we took. Of course, then subsequently we reduced weight because defensives and pharma did extremely well. We took some money out of it. Interestingly, pharma has for the last period not necessarily done great. Now, did we have any reason to believe that pharma will do badly? Everybody said COVID is there, so things will continue and things will get better. But we felt that slowly the market dynamics, when we looked at data, was turning and was transforming. And we found that, just looking at data, we felt that maybe it's time to start looking at taking higher risk. We also increase mid and small cap. So this is the point that how, we sort of looked at it, and some bit we also started, profit booking and reducing our risk on our portfolios almost like from September to October 21. This is just an illustration to say how sort of we manage this. Okay, about Right Horizons, our group started off in 2012-13. Okay, and we did. Our group started almost 2003. The PMS started in 2012. Okay, sorry for that. Okay, and so I'm the CIO and founder director of the RHPMS. I am supported by a team of two co-fund managers along with me. Okay, it's actually they've been promoted to co-fund managers. It's not assistant fund managers anymore. Okay, and we also have two additional fund managers on our platform. Okay, on our PMS. Okay, because one also likes to have some differentiated and diversification and different options to provide to clients. Okay, today on our PMS we manage over 600 crores of assets. Okay, and just a quick one on sort of what is the alpha, and what makes me really happy in this period is in a volatile period, and this is what one is trying to say, that if you manage risk effectively, okay, you will actually be able to see decent performance, and downturns can be a great period to pull away from the index. Okay, so you would see that of course a large cap, because it also has some bit of mid caps in it, in a period where mid caps will fall worse than the index, because we only comparing it with Nifty 50. Okay, and that will ensure that in periods of volatility it will do better, it will do worse than the index, and it's not something which is not expected from our side. But even then, you will find that across all portfolios, okay, we have seen some very, very good alpha, and a good part of it is about managing risk, including on what's interesting is also including on a small cap portfolio. Okay, when the index delivered minus 1.7, it did really deliver fantastic returns out there, and that's also to prove a point that we are saying that you can manage risk and in difficult times, including in a small cap portfolio. Okay, and we've seen it repeatedly in this particular small cap portfolio, that when markets fall sharply, okay, we don't fall as much, Okay, of course, this time it was it moved against the market, but if you see even a larger fall, you probably see that we'll fall lesser. Now coming back to again, where does all of this end, and the market cycles, and where are we now, right? So I think people always come back and ask me, where do we think we are headed? So at a overall level, I think this is an interesting chart to look at. The light orange line or light brown line is basically the P ratio, and you will find in that, just look at the period from 20 to 22, 21 to 22 probably, where that line is decreasing very sharply, which means that the P ratio of the Nifty has gone down very sharply, okay, in this period of time, despite the market going up, which means our earnings has been better than the growth in the stock price, okay, growth in the Nifty. And even through this volatility, you're finding that it only helped reduce the P ratio further, okay. And if I look at it from from a long term, and I look at it from periods when the P ratios, which is a table below, when the P ratios were below 22, right, we had 3-year performance in absolute terms. I'm not saying compounded. Okay, 3-year terms, okay, was 62%. Okay, which means approximately say 20% per annum is the growth one would have seen in the past if one invested when P ratio was say below 22. What's interesting is when it goes above that, right? So you find that the performance comes down very, very sharply, okay, and 16 to 18% over 3 years, which is somewhere between 5-6% over a 3-year period, even without taking for compounding. Okay, so that's something that one keeps in mind. Okay, so already at the place that we are today, I think we are comfortable on a valuation standpoint. Question is, can it go lower? Okay, that probably so. We saw that if global markets sort of come down, yes, we could see some bit of further falls. Now, just to summarize, and one wanted to keep sufficient time for questions as well. I can say, how do you balance risk and return? Our normal instinct is to pursue options that deliver best return. Okay, so today's survey was not surprising. Okay, the only thing is, when keep in mind, when returns are the best, it's not probably the past returns are the best. It's not probably the best time to invest. Okay, similarly, in a bear market, suddenly things may get magnified. I can tell you when is a turning point in a large cycle turning fall. Okay, many people will not feel like investing because you'll always feel it will fall a little more further. Okay, and markets could be volatile, so it throws up an opportunity one cannot afford to miss. Okay, so actually take advantage of it is what one would suggest. Okay, and I did mention that P ratios are good, so a further fall will definitely make markets more attractive, and in the long term, it may just look like a blip. Okay, you may say that, oh, you know what, you see a large fall, but you go 10 years from here, you'll probably see that things are far, far higher than what they are. Okay, and if you're able to, and I think the world is flat and there's so much information available. I think if you can start studying cycles for yourself, look at it, you can enhance returns. Okay, and what can help you stay away from taking emotional calls is possibly that look at decisions based on data, based on charts, and on that basis. And I would say, to end, okay, tighten your seatbelts for continued volatility, because I think it's not going to go away. We probably will see a few more rate hikes, etc. There's a Ukraine war going on. There's a whole lot of disruption that you could see in supply chains, and with inflation high, interest rates high, okay, things may just deteriorate. So that's something that we could keep. So I think that's all from my side, and I'll hand it over to for the question answers.
Anil, and in fact, very interesting questions are lined up, and I'm sharpening my sword to get answers from you. And the first question is, do you think the markets have bottomed out on 5 to 10-year averages, as it is very near to that? We are close to the bottom? Are we in the racing market and the corrections are behind us, is what an investor would like to know?
Okay, so I spoke of this where our P ratio is good, come down to 20 levels. It went down below 20, came up with this recent rise, etc. So some of that may happen, but I think as quarters move on, because we use what is a TTM, which is trailing 12 months for computing the earnings. Okay, so that may only get more attractive by falling P ratio. I have one or two charts. Yeah. So I wanted to answer that question. I kept a few slides where I was reasonably sure there'll be questions around. Okay, what could be the bottom? Right now, this is like crystal ball gazing, but what has happened with last markets falls, and where did it end? Right. So if I look at the first point is when we see large market falls like 2001, 51%, the P before the fall was 28. Okay, similarly, when we saw in 2008 a 60% fall, the P again was 28. Okay, it's almost like faithful. Okay, so at 2020, when the 38% fall, the P was 29. So you'll find that when the P is high, the chances of fall is much higher. Okay, and interestingly, when P is lower, 21, 22, it's a 30% fall, 15% fall. Okay, and the falls are lower. Now, if I want to say how far it can go, let me look at if I see, let's say in 2004, a 30% fall from 22, right? We'll probably come to around 17, 16, 17 type of range. And similarly, you'll find that in 2006 as well. If I see 2007 again, 15% on 20, you'll probably come to 17. Okay, so in most of the cases, what one is seeing is P typically, when P comes down to around 16 or so, and I would say, you could see extreme falls like you saw in 2001, and those are very momentary when the fall, sort of went down, and say in 2008, for example. Okay, so it may have gone down, but for a very, very short period of time, gone down below 16. So I would think that a good point for us to start buying into markets is when the P sort of comes down to around 16 levels, and you cannot perfectly time the market. So I would think that it's a good idea to start, in a phased manner, making investments even right from now to maybe possibly over the next 6 months. And why am I saying 6 months? Because again, if you study past market falls, like 2008 was almost like between Jan and October, it was over, almost like 9 months. So the falls are much steeper because fear is a more deeper emotion, okay, a stronger emotion, and typically the falls are faster and very quick. So that's the good news for us. Okay, but in some periods it's even gone to 18 months, and so typically you'll find anywhere between 9 to 18 months. So if I go back and see somewhere, things started on downfall from October, November. Okay, we probably think we have another say 6 months or so will be a good time, even from a time perspective, to look at for a bottoming out.
Yeah. The second question, Anil, with multiple headwinds like inflation, supply side shocks, FII ceiling, and interest rate hikes, how do you mitigate risk in the portfolio? How are you able to deliver that 48% mouth-watering return in the small cap? What is the secret sauce?
Yes, so I mean, a good part of my presentation was actually how do we manage volatility, and I use that as an example and to share, and hopefully, people can learn from that. I think so that includes, from being unemotional, when markets fall, to looking at data, looking at market cycles, following a process, etc. So I think all of these sort of add together, and I also discussed, the previous time, with an example during COVID, right? How the portfolio actually, went down. So I think it's about how we are able to sort of study markets. See, if one is if I cannot do it myself, right? And not everybody can be a fund manager. Okay, then we'll be out of business. Okay, but and some of us are really good at it, and like I said, where we have the interest and inclination, think the world is flat, right? So you can actually go back and start looking at it. How do I start taking maybe steps where, for simple ones, if markets are overvalued, P's are high, things look bad. Okay, slowly start in a phased manner, just moving. Just follow a discipline. So I think if I would say that if we follow a good disciplined approach, and some people do it differently, and whichever your style, I think follow it well. Okay, so like I like to be contrarian, and I like to do it in advance, right? So if you see broadly, whatever we did here was trying to look at the future, right? And again, when we went and fully deployed in March of 2020, when nobody had an idea that markets will move up so fast, because even we didn't think that COVID would with such a large impact would see such a rise on markets. So if we are just disciplined, and either we do it contrarian like what I'm doing, or we follow another way that I found some people do and they do it well. At the first sign of a turnaround, I run, right? So I just go and do the opposite. So I just stop loss, I book. So those are steps that we can take, but I think do it in a way that we are comfortable as ourselves as personalities, and I think that will be successful for you.
A recent interview, Anil, and the global head of equity strategy of Jefferies, Mr. Christopher Roth, told Ukraine war is already forgotten and discounted by the market. As war has not ended yet and no sign of it ending soon, do you agree with this view that it is already forgotten and discounted?
Yes, market definitely tend to discount things, and like we also saw COVID as well, and some of markets always right. Okay, so I would always say, just keep that in mind. Of course, it also has to do with our emotions and stuff. I'm not seeing too much of it in the newspaper either. Nowhere online, nothing, WhatsApps, all of it is right down, right? So I would partially agree with Mr. Christopher Wood that yes, it's now out of the minds of people, and from here, whatever had to happen on the markets have been discounted. But okay, the fact is also there that in the long term, a continued war-like situation will continue to impact, because right now you will see people taking different decisions, like suddenly the US, the EU getting a little more aggressive versus Russia and all of it, which may just, in fact, it may work to the negative of their own economies. Okay, by going aggressively on certain areas, okay, it may impact them more, and there may be a lot of noise, and there could also be impacts by when you see issues like this for a longer term. Okay, so I think while markets may have discounted most of it, I think if we continue to see a longer one, and governments take actions, okay, in order to protect a certain global unity sort of comes in there, and they take certain steps which can impact economies, then we could see further impacts. But right now, possibly, I think most of it is there with the information that we have.
The next question is also a very popular one, which keeps coming for all fund managers. The dollar-denominated returns are not positive for FIIs for the last 2.5 years. Do you think that the dollar and the rupees continue to get weakened at 79 to 80? Do you think the outlook on this for FIIs will turn around, and will they make a comeback? When do you think they will come back, Anil?
See, definitely, it's been very disappointing for FIs and any global investors, because even if there was some return here, the currency took it away. Now, one of the things I also study in cycles is, currencies as well. So first of all, I'll tell you the good news is that after you see volatility, there's a period that the rupee appreciates. Okay, you go back and see even after 2008 and stuff like that, and earlier periods of time, and there's large volatility. Post that, you will find that the rupee and emerging market currencies normally appreciate. So for NRIs, etc., okay, if you get the cycle right, you may get both together. Right? So if you invest at a point where, I'm just saying, let's say the rupee goes to 85, right, and it's crazy period. right? This whole hell breaks loose on markets, etc. It'll be a great time for somebody to invest into India. And I think FIs have seen that, been doing this in the past. Okay, so you will also keep in mind that some of, if one studies FI flows right now, right, part of it is because of the allocation to India as a percentage of emerging markets. Okay, so India dedicated funds have not necessarily seen outflows, and even if it is there, it is a much smaller degree. Okay, so it's more about people saying, I want to exit emerging markets, and in this index, say India has 20%. Okay, and India's percentage has grown up substantially. Okay, you will find that India saw a fall. Now, what could happen? And there are some noises around saying that some institutions are saying, let us look at the MSCI, which is the Morgan Stanley index, the most popular one, and many institutions just follow that because they don't want to look at investing into research resources all over the globe. Okay, so they use the MSCI. So that is something which we may find that the FIs come back with a vengeance and see a huge move on the upside. Post that, you can imagine what if both domestic investors and global investors come together and pump money into India. It will really go away. And one believes that, in fact, it's my personal view that this decade will be the decade of India, and in the market side. Okay, in terms of how market performance is. Okay, yes, we may see volatility, but I would think that based on my long study of markets over periods across cycles, I think we are sort of in a good relative place to most others. Okay, and in fact, if we see even inflation goes up, we have a lot more interest rates to bring down and soften the blow for the Indian markets. So those are things which India has, plus there are a whole lot of other things. So I would think that it is a good time for people to start looking at India, including global investors, and FIs will definitely come back. Time frame, I would still say similar to my view of market falls, say 6 months.
If the domestic flows are good and if they come back, nothing can be a sweet music for the markets. And the next question is, 9 out of 13 times in the past, when the Fed has increased rates, Nifty has outperformed. And do you think this time Fed is still not increased, the interest rate cycle is not fully over? We will get into the 10th time where Nifty will outperform the US?
Yeah, so that's an interesting one, because most people feel that interest rates hike means Indian markets will fall. So actually, that's the other chart that I had on my backup. Okay, is if you see, this is the periods when Fed hiked rates in the past, which is the brown bar lines. Okay, so if you see the Fed rates are sort of going up, and two things, the orange is the Nifty, and S&P is in the green line. Okay, so the orange line and the green line. So you'll find that, interestingly, both global markets and Indian markets have sort of continued to go up, okay, through Fed rate hikes. But of course, there's heightened volatility. Okay, so you will see that volatility sort of increases, and which is what we are seeing today. But the good news is you'll probably see markets going up despite interest rates going up.
The next question is, when the markets are in the correction mode, how do you protect the capital? Is it by identifying the resilient stocks, or you get into cash to it?
See, normally I like to do it before, right? So I like to do it proactively. So I don't want to take a decision when things are all volatile and things are chaotic. I don't mind getting out, a little earlier. In fact, on the wealth side also, when we saw 2008, right? So in October, November of 2007, when the index went to some 19,000, 18,500 of the Sensex, okay, we ended up, doing a profit booking for our wealth customers. So that is something that we had sort of done in the past. So I normally like to do that. But let's look at the recent time. The recent time was, where you found the PE was low. So we felt that, Indian markets could have, greater upsides, and we sort of kept that. But when we saw the larger market fall, when we saw a few indices break down, we saw certain metrics that we track break down. Okay, somewhere, again around March. Okay, what we did was we waited. Okay, and we waited a little bit, and towards the end of March, we took off, some of the exposure that we had to, for example, metals in our portfolio. Metal was a cyclical call. We normally don't invest into metals, but we had a longer term decadal view where we felt that the commodity should do better. Okay, and that's where we sort of entered into metals. Okay, but that was the first thing that we did. So I'm saying, so yes, at times, where you look for where are the highest risk and say take some of that out, okay, to protect from the fall. Even though we again communicated to clients saying that yes, we would like to ride through this volatility because the P ratios are not too bad for Indian markets, but on a stock portfolios where we have the opportunity to be more active, and especially we have a portfolio which is called FlexiCap, and we can move things around more flexibly. Okay, then we did take a few decisions and we took out some of the higher risk funds there. So yes, you would do partly through stocks. You may, in the past, we've done proactively, we've used gold ETFs. Okay, so when sort of markets were down, when we thought markets were at a peak and could come down, we used gold as well to hedge, because in a period of great volatility, you'll find that gold also runs up very sharply. So multiple ones. The other area that you can do is also between debt and equity, you can take cash calls apart from taking stock calls.
And in your own admission, the decade we are running now is India's decade. And definitely we will hit 5 trillion. What can be the great catalysts and what can be the greatest risks to hit 5 trillion, which is a landmark?
Yeah, so actually I had captured in the slide, maybe I didn't go through it, the points in detail, so let me just pull that up. Okay, so there's a lot of things actually which is working from India, right from infrastructure, the huge capital outlay that we are doing and we will continue to do. Okay, I think the manufacturing side is really going to do well for India after a long time. It's also the incentives also that the government is coming and giving in. Okay, that's a great thing that is happening. Okay, one of the biggest factors for us, okay, is demographic dividend. Okay, the median age in India is 28. Okay, and in the 80s, if you go back to the US, again studying market cycles now across markets, the US saw from the 80s onwards, it saw a baby boomers period. Okay, and that started when their median age was at 30. Okay, and from there, what it meant was a lot of people. Okay, because the median age is a combination. Some will be in 60s plus, and all some will be at an early age. So there are a number of people who were in an age which was below the working age, and they graduated and came into the working age, and that gave a whole lot of boost to the economy in the US. So that is also happening to India. The great part for India also is that this time India is much more educated than in the past. Okay, so even rural education has come up. A lot of things have happened on the educational infrastructure side, which is a great thing for India. Okay, in the past, we may have said that, yes, we may have added people, but they may or may not be, as productive. They may have come into working age, but they may not have been productive. But I think that demographic dividend is going to come in a large way for India. And that's part of our reason to say, we think that India, will be the country of this decade. And the whole fintech and the startup ecosystem, okay, is the other one which I think will add a lot more. Things have transformed. Yes, we may see falls, we may see corrections due to the Nasdaq and private equity and all may come down, but I think in the long term, the whole ecosystem has completely transformed. We were always, I think, reasonably well educated, smart, technically strong, and all of those, but we didn't have the guts to say, you know what, I can go and compete with the best globally. Okay, today you have startups, and if you're in the startup ecosystem and you hear some of the things that people are doing, it's just mind-boggling. Okay, and which is where you're seeing the whole sort of a lot of unicorns and all of it. I think we may see slowdowns, but I think it's definitely not going to go away because some of it is so entrenched in our lives, right? Right from the Swiggies of this world to the taxi hailing, to you name it, to the whole payment gateways, and transactions on UPI, etc., where we've gone ahead of maybe most other countries in the globe, right? So that is something that we believe, and I think some of these factors, along with lower interest rates, will help us come to the position that I believe as a leader of the decade.
See, I'll get into the next one. Arshit Patel is asking, apart from PE, and what other parameters do you look for changing the asset allocation?
Yeah, so PE is maybe the simplest and easiest to do. Again, within PE, you can look at other things. We will look at different ways of doing. There's a PE growth ratio which has come in, and so there are various other methodologies of valuation that you can look at. Okay, but what are the parameters? Sometimes it's important to look at various stuff. For example, gold is an interesting one. Okay, so it tells you when people are taking risk and not taking risk. Okay, so because it's become a safe haven type of instrument. Currencies also is something that you look at. You look at fundamental growth in the economies. Okay, so you can see things on the ground, how things are moving. Interest rates is another one. Okay, so there's a whole lot of stuff. I also believe, and in my study of cycles, I look at a combination of fundamental as well as technical, because sometimes some of the technical indicators have given me the red flags when nothing else has come up, in terms of a red flag. So even recently as well, when we sort of pulled back and took a bit of a cut, we did that right when we saw the red flag coming from the technical side and things started breaking down. Okay, so those are combination of things. Is some of it is about experience, some of it you have to see it. Okay, you again have to train yourself to see which PE band. Okay, because P may go all over the place. So should I do at 24? Should I do at 20? Should I do at 16? Okay, it's very difficult, right, to say. So it's about how you can look at a whole lot of factors along with earnings, along with profitability, along with growth, and relative. Like one of my things about India is the relative to other countries in the globe. I cannot think of any other country who will be the leader of the next decade, right? So I think it's a whole lot of qualitative, quantitative, but focusing more on quantitative factors. Okay, and that is something that one can look at. One could even just be cycles, right? If you just the simple thing, you just look at, for the last 30 years, say, what is the percentage of a sector in the index? It'll throw you fantastic, data points, right? So those are things which you can look at as a combination.
The next question, Anil, and in fact, what catched my eye, same thing catched the eye of Prashant Patel.
Okay.
Asking, how did you manage an alpha of 48% in the small cap PMS in 21-22? What is your view on small cap versus mid cap versus large cap currently? With the 3-year view is what he wants to know.
Yes, so what we felt in the small cap thing was, yes, definitely. So it's a portfolio which is maybe for patient investors. Okay, and some people got uncomfortable, in fact, in the same fund. Maybe in say 2017 when it underperformed. Okay, but that's a point to sort of keep in mind. And in that period, it underperformed because when junk runs up, right, the end quality is punished. That is where the portfolio was punished. So that's how markets are, and you cannot do nothing about it. Now you may go and do a great deal of research, all of it, look at companies, best quality and stuff. But okay, you know what, the junk runs up. Right, so that's how markets are, and that time somebody would have felt, okay, he's a bad fund manager, right? So of course, I don't manage the fund. Piyush Sharma, who has a long track record on the same fund across fund houses, we found good value in his style, good quality, looking at forensic analysis, looking at the quality of things, looking at cash flows, looking at parameters beyond, just what is there. For example, while he bought PVR cinemas in the past, of course, that was long time back. Okay, he went and looked at how many crates of Coke were being shipped. He took a dipstick from Coke, right, as to how many crores and how that is moving up, because actually some of it is, that's where the money is, right? So it's about how you look at those underlying factors and stuff, and those actually help. So we always say that evolved investors are willing to stay that 6 years, fund like this is that what you look at, and that's a style that some of us also can look at. Okay, and we should not get disappointed when that style doesn't work for us when you're looking at quality, right? So you need to stick your guns out and you say, yes, I will still continue to hold that. Now, coming back, what is our view mid versus small cap and stuff like that? Now, the other interesting part about his portfolio is you will find that at periods of time when small cap falls sharply, like what we've seen, it may fall in line with the large cap index. Okay, but it very rarely, we've not seen it fall worse than the small cap index, because sometimes some funds take a higher level of risk to deliver a higher return. Okay, so it is not about delivering taking a higher level of risk. Okay, so it's about how the scripts get discovered, right? So is what we're looking at it. So now coming back to mid versus large cap and small cap. Okay, so our data was showing that in March. Okay, so we were somewhere about halfway through. Okay, March, April of the mid cap and small cap rally when we looked at relative valuation and some of the charts that we looked at. Okay, so that is something which we have looked at in the past, but we just kept it a little cautious right now, keeping an open mind that do we think that mid and small will continue a little bit more? But yes, we have sort of like in a flexi cap where I need to move between large caps and mid caps. We have reduced a little bit of the mid and small caps. Okay, that's said and done. If you're a patient investor and if you see some great points that come in, right, at let's say if there's a further fall or something like that, then you may just see the returns can be mind-boggling. Okay, as long as you're looking at funds which take care of quality, right, and you have a time frame which is longer, right, you will probably see it will not make too much of a difference. But yes, from our thing side, I think that large caps, there's a cycle which will turn and large caps will do better, possibly over the next year or two. Okay, but I also think that we have to see whether that mid and small caps have already ended it, because as per the relative valuation charts, we've not necessarily seen the last part of it.
When your fund manager goes to PVR, whether to load to Varun beverages also he needs to look at, I think. And the next question is, you have answered this in the previous question partially. Is it the right time to invest? Kulwan Singh is asking this. Is it the right time to invest in the large caps having P less than 20 is what he is asking.
Yeah, first of all, I'm too tempted to respond to your Varun beverages one. Okay, so I think we've not seen too many damages on his portfolio as well, because before he touches any stock, he does a forensic analysis. Okay, and very, very thorough on that. So that, because in small caps, okay, if you have any damage to a particular stock, right, the damage can really be significant. Okay, it just can go off into zero almost. Okay, so that's something that we need to keep in mind, which is why when you're dealing with small caps, you have to be even more careful. Now, your question of whether it is time to start looking at large caps, and yes, I definitely think for investors, fresh allocations, relatively, you should look at larger allocations too. I may not do large caps right now, but I'll at least do something like a flexi cap or thing, because things may still be dynamic for some period of time. But yes, I would say a slightly more large cap bias, is what one could look at in the current time, especially when I'm seeing. See, with us, we move between large and mid cap. So when I'm looking at portfolios from outside, I see a lot of investors have significantly got into mid and small cap. So this may not be a bad time to, bring that ratio back and add a little bit of large caps.
Yeah, I'll get into the next one. And Anil Dalmia is asking this. Hi, sir, and why are your alpha returns versus different were different in the three other categories, not similar or close to small caps? And he is asking why you have created a huge alpha in the small cap is what I have understood this question.
Yeah, so I have already discussed about the small cap thing. Sometimes it's like this: when you look at undiscovered names and they transform, the thing can be very, very huge. Okay, so that is there. We like our portfolios to be different. Okay, so these are two. We have different fund managers for these portfolios, and the whole point of it is that. But in 2017, you may have seen the opposite, right? So I'm just saying that, which is why we believe that you have to diversify and you have to look at a combination of strategies, right? In across the whole things. Now, yes, even the flexi cap and some of them have had periods when they have done pretty well, but there we are the style is slightly different, where we are more diversified. We don't take as much of concentrated bets. Okay, because we have different types of clients and we want to serve their needs differently. Okay, so that is the whole point of where I think and I believe it's a good idea to have a combination of strategies and different styles as well, because you don't want, if you diversify across three funds and all of them fall in equal proportion or go up in equal proportion at the same time, it's definitely not a good diversification for you. So that's our philosophy, and so I think it's a good thing to have.
I'm ahead of schedule, and we are ahead of schedule by 10 minutes. So I'll please allow me to take the last question, if you don't mind, Anil. And this is a question from NR. Okay, he has put his initial. Could you define your specific strategy in terms of equity versus cash holding? How do you typically ensure that customer get the desired return?
Yeah, so see, again, desired return of the customer is very difficult to gauge in the first place, so it's a difficult thing. But yeah, so our point has always been, how do we deliver a better risk-adjusted return, right? So what that means is, even if I and let me explain. Let's say I have a 15% return for one fund and 15% from the other, but one of it has fallen 60% and then come up 75%, or something which has fallen, say 20-30% and still deliver that 15. Our experience is that for most investors, okay, they're looking at a return which is, say, better than the average, better than their fixed deposits, other avenues, better than our mutual funds and all of it. But they also don't want to see a very high volatility. So the experience goes very bad, because you don't want to have sleepless nights, because in the end you may deliver, instead of 15, you may deliver 17, right? So if you have, and so there are some strategies which take a higher level of risk to deliver a higher level of return, then you will find that really large volatility, and it may really trouble you. You may not have a good night's sleep. Okay, so I think that how we are able to look at a sort of a risk-adjusted return, and in their overall scheme of things, to manage risk. And that's my parting message to everybody, that many times you look at return, okay, in your portfolio and in your investing journey, just go back and give risk a little more weightage in your journey, and I'm sure you will do very well.
Absolutely. And in fact, the return is outcome of managing risk is what I totally agree with you. Thanks for giving your evening. I want to thank each and every participant. I want to thank the fund house, Right Horizon, and Mr. Anil for a wonderful presentation. Thank you very much, Anil. Thank you.
Thank you. Thank you, Mr. Shivaram. And it was a pleasure to be on the PMS Bazaar platform. And good to see that you have, really created a niche and a platform where, people can actually compare between fund houses and make a logical decision. Thank you.
Thank you for the kind words, Anil. Thank you very much.